Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Mark, g'day mate, and welcome to the show.
Hey Owen, thanks for having me on.
It's something we've been wanting to do for a while. We've chatted on and off about it, and I guess no time like the present. Where are you now?
So still based in South Africa. I was supposed to be in Sydney late March, and that obviously didn't happen. So continuing to watch everything ASX microcap from afar. And it's definitely been an interesting few weeks, no matter if you're in the bond market, oil market, microcap market, large cap equities. It's been a crazy few weeks, but interesting, and lots of opportunities as always for people who are on top of things.
Yeah, absolutely. It's one of those markets where I think if you're an active investor, this is kind of what you look forward to, provided you're not getting burnt too badly. I think it's one of those things where everything's just exciting. You don't know what you're going to get the next day. I figure a lot of our listeners will probably know of you, have seen some of your research around, or maybe have interacted with the company that you founded, which is Coffee Microcaps. But perhaps you can just give us the Mark Tobin 101 and tell us a little bit about yourself.
So obviously, to make things more confusing, an Irish guy who's like very focused on ASX Australian microcaps. Grew up in Ireland and ended up in Australia in 2007, and was there for a while, and then went and worked in London for a while, and got a hankering back for the beaches of Sydney, so came back to Australia 2010, and I actually lived in Australia for 5 years. And during those 5 years, I was working with Wilson Asset Management. I'm sure a lot of people would know them. They were a much smaller outfit when I was there. I think when I started, there was only 6 of us, I think, in the office. We were like managing about 700 million across 3 LICs at the time, and Matthew Kidman was still with them. I was working with Jeff, Matthew, Chris Stott, Martin Hickson, Chris and Mark now, who've recently just left Wilson to start 1851 Capital. I worked there as an equity analyst, and I mean back then they've got a few more strings to their bow now, Wilson's, but back then it was very small cap equity boutique focus. So that's where we spent a lot of time looking at. But within one of the portfolios there was a little subgroup that was focused on microcaps, where we looked at, I think there used to be 10 in that group, where it was like 10 microcaps we thought had the potential to, really grow significantly and move into the wider small cap market. And that was the part that I loved, looking at stuff that you didn't necessarily hear from brokers or other analysts or portfolio managers you meet walking up and down Macquarie Street or at briefings, trying to reverse broke their positions to you. So that was the part I loved. And then, so I've always been very focused on that side. And then about a year and a half ago, my own personal situation was I was getting very frustrated that there wasn't many outlets for like microcap companies to get their story out there. Especially if you're not in the junior resources end of the market or the biotech side of the market, which I think are actually very well served in the Australian context. So I said, right, I'm going to start my own conference, and I'm going to get the companies that I want in to present, and I thought I had a pretty good network of kind of like-minded investors, but on the retail, mums and dads, and on the obviously institutional side from people I used to know in the industry. And yeah, we did the first conference back in April, had great feedback on it. Did another one then in October, which was about twice the size of the one in April, and we were supposed to have, I guess, the third one in March. It didn't come to fruition, but now we're starting to move things to the virtual sphere, doing some content online in terms of getting companies to present, and yeah, still trying to help companies get their story out there, because I think there's a lot of good companies in the microcap space that just don't get an opportunity to air their story.
Yeah, it's one of those things, right, where they want the attention. You want to give good companies a platform, but you also kind of want to avoid those that can potentially damage your reputation. But I think as we'll get through in this conversation, being in small caps, being in micro caps, it's been your focus for such a long time. And I was hoping that you and I can talk about why it is that small caps appeal to you from a higher level, kind of get the lay of the land, and then maybe we can jump into some of the more recent events.
Yeah, I mean, I think the appeal to me is because they're exciting. They're generally in industries, new industries, there can be like market leaders, highly innovative. It's much easier access management, so you get a better understanding of the company. A lot of the ASX 200 guys, you'll maybe see those management if you're a retail investor, or get to chat to them one-on-one, be at the AGM, if even then. Whereas in the microcap space, you can get a better understanding of the company, who's running it, because management are a lot more accessible, I would say, even for retail investors. And just the potential to grow. If you see, CSL or West Farmers or, CBA, if they're up 20-30% in a year, that's a good year for them. Down the microcap end, you can have stocks that are up triple digits, and that's not unusual. Similarly, you can have ones which are down 70 or 80 on the flip side. So it's not all a bed of roses down here. But to me, it's like the ability to get the outsized performance gains on the microcap end, as well as the kind of general interest factor. It's not, they're operating in small niches of either the Australian economy or the global economy, if they've got a global business, where you mightn't have even thought that this was an industry, but it is. In terms of lay of the land, I mean, Australia is quite a big microcap market. You've got just over 2,000 companies listed on the ASX. And, outside of the top 200, you quickly fall away and start getting into microcap land. What is a microcap? It's a very loose definition in Australia, I find. In America, it's a very hard and fast definition. It's anything under $300 million as a market cap. In Australia, some people use that. That's what I use. Other people say it's under 500 million. Other people would say it's anything outside of the top 200 index. But whichever way you slice it and dice it, you'll end up with a universe of 16 to 1,700 companies that can potentially fall into the microcap definition for Australia, depending on what you're using as your benchmark to define a microcap. So there's a lot to look at, a lot to research, and you can very easily, I think, build a portfolio of microcap companies, which would be significantly different to what you're holding in an ASX 200 ETF, or probably what's in your super fund, given that the super funds play around in that large cap end of the market. And the other thing with microcaps, which is, when I mention ETFs, that's I guess a bit different to the rest of the equity market, is you can't get access to microcap ETFs There's a few in the US. I don't think they actually serve their purpose. I think it's a bit of mismarketing. But there's none in Australia, and there's a few reasons why I don't think it would work from a structural point of view. But that's another reason, why I like microcaps is because you're not competing with ETFs. Your prices aren't getting distorted by ETFs. The prices are literally what the buyers and sellers are doing on a particular day.
One of the things about those small cap ETFs is that some of them use it's not a full replication strategy. So they don't use, they don't follow a standard index because they can't buy everything because the tails are so long and the liquidity is so low. So they'll use, synthetic exposure like contracts or futures and those types of things. So I see that all the time from looking from the funds and ETF side of things. When you're researching those, you see it. It happens quite often. But we've spoken before about one thing, and that is, we talk about, so there's like maybe a potential liquidity premium there for small cap investors and micro cap investors. But we've spoken before about analyst coverage and how that's also something that you might come across. It might be few and far between when it comes to some good quality small caps.
Very few and far between, and actually getting less. Some recent research, I say recent, probably came out last year from the guys at Goldman Sachs, and they were just doing analyst coverage across small caps. So like for micro caps, it's going to be even less, but I think the trend, you can easily, replicate the trend down into the next lower level. So in small caps, just to reference the actual research, analyst coverage has been coming down since the GFC. There's less analysts around, there's less coverage. And within the coverage that is actually happening, the analysts are all tending towards the sexy names in that particular part of the market. So, if it's, resources at the time, you'll see a lot of analysts will be focused on resources, or if it's tech, there'd be a lot of focus on tech. But the analysts that are even covering small caps are all tending to follow the same companies. So the spread of analysts and across the spread of companies is actually getting narrower. And then if you go down into micro caps, it's even less to maybe non-existent. Most of the micro caps I look at might have one broker following them, and that's at the margin. I would say it's definitely not true, especially if you get under like 150 million. They probably have no broker coverage whatsoever. They might have a few stockbrokers who are kind of across the story, or an analyst at a particular house who's monitoring them because they are a competitor maybe to a bigger, larger incumbent, or they're in the kind of same industry sector, so they're just monitoring them from afar, but not, really doing, I guess, the research notes that people would receive in their email inbox. So yeah, that is definitely coming down, but that's also creating great opportunities, I think, for retail investors, because you can then do your own work and find names that are off the radar of the broader institutional market, compared to what you can find in small caps to an extent, but large caps, it's very hard to I think get an edge on what is known about the company. I just checked there quickly before we came on. I looked up BHP just out of interest sake. It's got 87 analysts globally covering it. So I don't know what research a retail investor could do that these guys haven't uncovered. Whereas I could look at some of the microcap names, and if I pull it up in Bloomberg, there'll be zero analysts covering. There'll be no information there. So that'll just give you an idea of like the depth. And basically, as you come down the ASX, the analyst coverage starts to fall off as the market caps get smaller and smaller.
You mentioned, like, there's so much to talk about when it comes to micro caps, and I think it's something, I don't know if it's paradox, but you would say there's so much more alpha opportunity in smaller micro caps, yet it gets so little attention from analysts. I mean, I reckon if you ask most equity analysts if they want to cover small caps, they'd say absolutely, because that's where they see the opportunity. But I guess the institutional side of the businesses that they work for want them to cover the blue chips and what have you. One of the things I wanted to talk to you about was effectively how you go about finding information on these smaller companies. Like, what are the resources that you use?
So I mean, the number one resource for me is the ASX announcements page. That is like I look at that daily. I usually wait till like the end of the day, like 5:30, 6 o'clock, and I literally go down through every single announcement. And if the ticker code isn't something I kind of recognize, I like click into it, or anything that comes up with the little red asterisk. If it's not a big 200 name, I'll like click into it, and like that's the starting point. So then you'll come across, because even for me, for somebody who looks ahead, I came across a company the other day. Flow hit end of October last year, didn't even know about it. I saw an announcement coming up about it the other day. So there's things, because some of these floats, they're raising 20 million, and they manage to get that away pretty quickly, and it lists, and you just kind of miss it in the day to day. So I think that that's probably the number one resource for me. Twitter, I think, is a very good resource as well. There's a lot of smart people on Twitter, posting either research that they've done or insights that they have. And obviously you got to take away a pinch of salt and know there's probably some hidden agenda behind it. But as a starting point to finding new names and things to look at and things to research, I think it's a very good resource. And one that's, I know you have spoken to Andrew a few times, that I think has come along in the last, say, 2 years, which I think is an excellent resource, is Strawman. There are some very, very smart people posting on Strawman, and just even following what they're doing, the research that they're doing, the insights that they can give on stocks, how they think about valuing them. I think that's another important point that comes across in Strawman a lot. I tend to look at PE as my kind of valuation metric. Other people use discounted cash flows. Other people use, EV to EBITDA. I know has become very popular in the last 18 months. When I was working as an analyst, we hardly ever looked at that. Whereas now it's become quite popular as the main metric I see analysts quoting in the paper or on TV or whatever. So none of these valuation techniques are perfect. Sometimes you need a kind of a blend of them, or just use the one that works for you, knowing what its limitations are, because none of them are perfect. But I would say they're the top three: the ASX announcements page, number one; Twitter, number two; and Strawman, number three.
Yeah, some pretty solid resources, and they're open for everyone to use. I'll put some links in the show notes to follow you, because I know you produce a lot of small cap and micro cap insight. One thing I want to talk to you about is people think about smaller micro caps, particularly micro caps, because I guess it's this issue that we have with this information asymmetry. There's not a lot of information out there, but if you do look hard enough, you can find the right stuff. But then from the company's perspective, they want the story to be told. And sometimes they shout it so loud that you can think, oh, geez, these guys are, they're just promotional managers. Do they actually know what they're doing? You mentioned earlier on about just reaching out to management. How do you find it in micro caps with dealing with management? And are there any like rules of thumb you use for, we talk about skin in the game all the time, right? But are there any rules of thumb that you use for identifying good quality management versus those who are more spruiking it and promotional?
Yeah, I think, a couple of points on that. I think management who don't engage with potential or existing shareholders, that's like a big red flag to me, because that suggests that the company is listed, but they don't really care about their shareholders. So they're like running it, for the benefit of a couple of insiders, the board, the management, one or two large shareholders, something like that. Just to give you an example from the Wilson days, we came across this company, I won't name it, and I pitched the idea at our Tuesday ideas meeting, and Chris Stott said, yeah, no, it sounds interesting, give them a call, try and get them in for a meeting, or we'll go out there. They were based in Sydney, I think in North Sydney somewhere. Anyway, I called the CFO, and he basically told me in no uncertain terms that the top 20 own 78% of the company. So like, why are you phoning? There's nobody going to sell down. Like what's the point in having a meeting? I was like, okay, well, why are you listed then? Why are you like putting out like results and presentations? You don't want like any external interest in the stock. So I mean, and that's coming from an institutional fund manager calling a company about becoming a potential investor, and they had no interest in us. So I think on the one side, companies who don't promote themselves are nearly just as bad as the over-promotional ones, because if you don't promote your story and try and gain a bit of interest, where does the marginal buyer come from? Where does the price discovery come from in terms of actually reflecting the true value? You can have a company that very quiet, doesn't do anything, and it's on a P of let's say 8 or 9. But if they actually communicated, not in an overly promotional way, but with a standard, I would say, investor relations program, they could probably be trading on maybe 12 or 13 times. So I think not promoting is nearly just as bad as over promoting. The over promoting ones, I mean, I think they have a great saying here in South Africa: every sport has its injuries, and the over promotional ones are just like that. They're just part of the universe, and I think if you follow the universe for a while, you tend to spot the ones that are doing it. Even if you click into again, the ASX it's not the greatest website, but it does have one good function is, when you go into the individual company and they'll say, like, look at all their announcements for like 2020, for example. If every second one has like those little red eyes beside it, exclamation marks, you can say, oh, these guys like to tell a story, maybe a bit too much. That's a red flag for me. You mentioned skin in the game. I think we talked about this before, but I come from a slightly different angle in terms of skin in the game. Better to have it than not, I'll say that from the outset. But when insiders own too much of the company, they can start, I find, like just running it for their benefit and not to the benefit of minority shareholders. I see a lot of marketing from the small cap institutional managers, what do they look for their companies, and they list out a whole lot of things like skin in the game. They want management aligned with shareholders, which is good to have. But I find if you get kind of over that 35% level, I found of insider ownership, then they're like, say they own 60% of the stock is tied up between the founder, who might be the chairman, CEO, other directors, CFO, then I find they generally are not really operating in the best interest of shareholders. So I find if you have management and board kind of in that kind of 15 to 35 bracket, I think you have them sufficiently aligned with minority shareholders, but not overly, kind of overly positioned in the company that, they kind of dismiss the needs or wants or even suggestions of minority shareholders. Because I know a lot of like active microcap investors, and they'll often do presentations to the board where they've done, a lot of work on, here's comparable companies, here's suggestions of what we think you should do in terms of, selling off non-core assets, an investor relations program, instituting a DRP, maybe, other capital management initiatives, and gone and presented to two boards, 2 or 3 of them maybe together. And they're like, yeah, guys, thanks for coming. Nice presentation. And, they just like walk away from it. So you can get that. You can get that in the skin in the game situation. I find in microcap, large caps doesn't happen. I mean, you look at the back of the annual report for CSL, for example, all the top 20 shareholders, they'll all be like, generally these days anyway, there'll be big index fund providers, Vanguard, BlackRock, And then, a lot of the large super funds will be in there as well. There'll be no like retail guys. You flip that around to the microcap annual report and you go through the top 20, it's all generally, people's SMSF accounts, little PTY holding companies. It's much more retail focused. And companies gotta be able to, when you're a microcap, you gotta understand that you're dealing with, retail shareholders, and they have different needs to the institutional shareholders.
Absolutely. You mentioned 35% there. I think we've talked about this before. So it's kind of just like a rough rule of thumb, right?
Yeah, it's just a rough rule. It's just one that, I've kind of come to find it's like a happy medium, looking at a lot of microcaps like over time, that, when you've got large shareholders, let's say they're at 60%, one, they're not really sellers, probably not buyers either. So it decreases liquidity. If you decrease liquidity in an already low liquidity environment, doesn't anything to help the like share price or valuation and price discovery. Whereas if they're kind of down in that like 15 to 35, I feel like they've got enough invested in the company. It's probably a large chunk of their like personal wealth tied up in the stock. So you get that alignment, that skin in the game that a lot of fund managers talk about in their marketing, but not so much that, that they can be sweating something that they're going to try and get maybe a contentious, executive remuneration package or something like that they're trying to put through at an AGM that's not going to be, a simple straight through vote. There's enough kind of minority shareholder interest there that if they wanted to get their back up about something, that they actually have enough power come AGM time or an EGM to say yes, no, to certain resolutions that might be put to them. So that's why I kind of feel, as I say, there's no, empirical evidence from the academic community that I'm referring back to. It's just a rule of thumb from, I guess, a bit of market experience over the years.
For sure. And I think that's a fair enough line in the sand, to be honest. In my experience, I can't think of too many microcaps that I've invested in where the founders own more than 50%. Maybe Pro Medicus, from memory, they own quite a bit when I first invested in them, but I can't think of too many that have gone to over 35%, at least at initiation. One thing we talk about a lot, and I guess it's this common, maybe it's not necessarily a misconception, but I guess just in investing in its entirety, we talk about volatility as a measure of risk. I'm probably more on the fence of dismissing that as a measure of risk if you actually understand what you're doing. And when people look at microcaps, they think, it's volatile. Like you mentioned earlier, when it's up 5%, it's down 10%. Like, some people that are particularly new to investing can't make heads from tails. You recently wrote an article about this, and you did this kind of quantitative study over I think it was the Small Ordinaries Index, where you looked at the absolute moves for the index during coronavirus. And I thought that was a really interesting point for us to discuss, because some of the findings in there were, they are quite profound. And I think it serves the point of, volatility is your opportunity when it comes to microcaps.
Yeah, so the one I looked at was actually the Emerging Companies Index, which is the ASX Microcap Index. And basically what I was trying to see was, was, say, the back end of February, up until about the third week of March, was that as volatile as the GFC? Because that index actually goes back to 2003. Right. Or, because we've been in such a long kind of upward trend bull market, maybe we've just forgotten about kind of big down days or down months or whatever. And while March, the quarter itself, if you go like Jan to the end of March, it was just a hair under being as volatile as the October to December 2008 quarter. But if you disaggregate it down to the next level in terms of monthly figures, March in terms of volatility was way above October 2008, which in that kind of quarter was the most volatile month. It was about 30% more volatile than October 2008. So like March, in terms of volatility, is definitely the most volatile month for ASIC microcaps we've seen in the last 16 years. That's as far as the index data goes back. And definitely way, way more than was ever experienced in any month through that, let's say, August 2008 up until March 2009 type period during the height of the GFC. So way, way, way above it, which to me I think creates opportunities. And there was some opportunities which have even now I think like evaporated because of the strong bounce we've had coming out of the last week of March and let's say the first 3 weeks of April. And that's the thing. I did an article about this. It was probably about a year and a half ago or 2 years ago now. You know, you got to have your bear market watch list. I think we discussed that at the time. You know, companies that you like, where you think, oh no, they're like too expensive, or the usual saying, like a lot of the brokers will give you, yeah, but it's always expensive. So like buy it now anyway because it's always expensive. But you got to have that list off to the side and be ready to act on it then when, you know, a situation like March arises, that, you know, you get the baby being thrown out with the bathwater, and now is a chance to, like, you know, buy things that you've been wanting to buy for a long time. But, you know, the valuation hasn't allowed. And you got to have the, you know, your outlook on the company, how it's affected by coronavirus, all that. Take that into account in the decision, but you got to have that list. The other thing I think as well is, you know, volatility. I agree with you. You know, I don't think it's a measure of risk at all. The risk is not knowing what to do in volatile times. So if you know your portfolio well, and you know the price is like really dropping, you'll know I should be buying more, or I should be selling because, you know, the forward outlook is, you know, terrible given, you know, what part of the economy the company operates in. But that's all about understanding what you're investing. If you know what you're invested in, you can react to the volatility and whatever that might be. It might be holding, might be buying, might be selling. But if you know what you're invested in, then volatility, you know, it just provides opportunities one way or the other.
You mentioned that from the study that, you know, it was a very volatile month. I know we don't like to look necessarily from a top-down perspective, particularly when it comes to microcaps, but if you were to throw something out there, why do you think that it was such a volatile time, even compared to the GFC?
I think it was more volatile than the GFC because, you know, this is a global pandemic, which we haven't experienced unless you're around for like the kind of Spanish flu in like 1910.
Yeah.
The GFC started off in the US, and I mean its tentacles reached everywhere in time, but the speed at which coronavirus was impacting, you know, countries and economies, I think that was different to the GFC. You know, I remember working at the time when you know, the like subprime thing started going, and one or two hedge funds at Bear Stearns started to get into trouble who were doing, you know, subprime mortgage-backed securities, and you know, it was like a niggle off to the side of the market, and it then just became progressively bigger and bigger and bigger. You know, coronavirus, you know, it started off in China, but, you know, very quickly started engulfing, you know, lots of economies, countries, and, you know, now there's basically kind of nowhere untouched globally. So I think the speed of from problem to, you know, worldwide problem, I think that was different to the GFC. You know, I think there was a good 7 to 8 months from when those two Bear Stearns hedge funds kind of was the first inkling of like things were not happening right, to actually, you know, October 2008, like kind of the worst month in that period. I think you had that like kind of longer spread. I think that's why things were more volatile in March, you know, right right round the markets compared to, you know, the GFC. It was a lot more concentrated due to the kind of the speed at which the virus started disrupting economics globally.
I'm going to switch gears here a little bit. And when we talk about this risk and the volatility and opportunity, you mentioned that maybe it's bounced back so quickly. Maybe it's because it's an Australian thing. You know, as we record this, it seems we're getting slowly on top of things. And I say that, you know, touch wood. But for you, did it present any opportunities during the most volatile period of it? And I guess the follow-on to that would be, are you still seeing that now, or are you thinking it's a lot more, I guess, it's well priced now in microcap land?
Yeah, I thought coming into it, so to kind of give you an idea, I thought coming into it, I thought microcaps generally were expensive. Like I was finding it hard to find anything that was like cheap, good value, you know, anything that was of reasonable quality. I think had gone up a fair bit. You know, the index itself was up about 30% in 2019 and had a good January and, you know, early start of February. So I thought things were expensive. For the really good quality names, I think like Energy One I think is one we kind of both know. I went from over $3 down to I think $1.60 or something like at the lows. At $1.60, I was like, yeah, it's fair value now. I wouldn't say it's cheap, but I thought it was fair value. Like I was kind of hoping you'd get back to $1. But you know, and that was kind of replicated across a lot of other names that I look at. You know, they had come back a lot, but I still didn't think they were cheap, like outright cheap.
Yeah.
For I guess the potential I kind of would see for them going forward. I would have said they were like fair value, and you know, maybe they were if you didn't own already to maybe get a position in them. But if you already owned them, I was like, is there a really compelling reason to like kind of buy it at this valuation? And you know, a lot of those now, you know, have kind of bounced up 30, 40%, and now I think, you know, they're probably on the overvalued side now. Not crazy valuations, but I would say they're kind of overvalued at this point with the bounce back. But you know, we're going to see a lot more in terms of volatility play out, especially over the next 10 days, as a lot of the Appendix 4C start getting reported. And when we get the June results in August. And I think we'll have a better idea of how things have affected these companies and what the outlook will be, given under whatever this new normal is going to be. And there might be some opportunities around then if people see that through the 4C or through their annual report that's going to come out, actually they were harder hit than I thought, or you know, it's going to take them longer to bounce back, or you know, they're finding it difficult to operate in the new normal.
Yeah, there's a lot of, I guess, just you could call it a V-shaped recovery in microcaps. I guess the thing is, people should be mindful, as you said earlier on, to have that buy list, to have the list of stocks or companies that you just would love to buy, you just don't think the time or the valuation is right. And I think I tend to agree there, because I feel like the bounce back has been so sudden, yet the information that we have on hand to know for certain if these companies will or won't be impacted, you know, it's just not enough to justify some of the bounce back in some companies. Like there are a few names that I know of. For example, I'll give one example, which is a company called Volpara, which is slightly larger than probably you would ideally look at. But it's a brilliant company, but at the same time, you know, they're acknowledging that there are going to be issues, and they're doing a capital raising, but it's snapped back pretty strongly, and now it's, you know, the capital raising's kind of dampened it a bit. But at the same time, we just don't know, so it's very hard to put a valuation on that. I wanted to maybe end this, as we come to the back end of this short conversation with you, Mark, and ask you, as a micro cap investor, as a small cap investor, I don't want to stamp this conversation with something that's kind of like transient, but when it comes to small cap investors, and particularly the private investors that you deal with and that you interact with, when it comes to their portfolios, I'd love for you to give an example, if you have one. Maybe I'm just catching you off guard here, of some returns or some type of figure that I guess people who haven't invested in microcaps can really think about. I mean, I know of personal portfolios that have compounded at 20 to 30% for a very long period of time because people have really put in the time and effort with microcaps. Have you come across that type of thing?
I'm going to be putting it out next week. So it's a review of all the like microcap fund managers and their products.
Cool.
And like over time, I mean, the numbers look, not great now after March, but for the longer term funds, who've got like a 5 or 10 year track record, they're still, up in kind of double digits on a 10-year basis, like even with a big drawdown, plus 20% in March. And they've generally outperformed the index. It like goes back to that alpha. The majority of like microcap fund managers that I follow, if you put them against the ASX emerging companies index, they've generally outperformed that because of this informational asymmetry. And if you do the work, you can find it. So I think it's, would I advise anyone to have 100% of the portfolio or the SMSF in microcaps? Absolutely not. But I think it's definitely, from a diversification point of view, a conversation that people should have with their financial planners, advisors, wealth managers, whoever they're dealing with, in terms of trying to, you can diversify away from the large cap Australian equity exposure and get like differentiated returns and a differentiated look to your portfolio. But on the flip side of that, you don't have to go into international equities and worrying about currencies and the impact of that on returns in your portfolio. So you can get equity diversification, but Australian dollar based, and not have to worry about like hedging in international equities in order to try and diversify your equity portfolio. Because even, when we talk about diversification, it comes back to the ETFs again. Take the ASX 200, 45 or 8%, I think the last time I looked, it's made up of the top 10 companies. So you've got 200 in there, but the top 10 are driving, 50% of the performance. So how diversified is that? And same with like microcap ETFs. We don't have them in Australia, but I looked up the main one in the US, which is the like iShares microcap ETF. The number one holding's got a market cap of $4.6 billion. So, it does, to me, it'll be very hard for anybody to do a proper microcap ETF because, one, as they try and, if they do the full replication strategies you talked about, as they try and do that, they bid up the prices, and then suddenly, the market caps move up, and they're now no longer microcap. So they got to be like rebalancing, I would say, nearly on a monthly basis in order to try and keep the market caps within microcap. And that same US one, I went down through the whole of the top 10, and the average market cap of the top 10, and it's a microcap ETF, was $2.2 billion. And if you apply the exchange rate that to put it into Australia, what would that be? 2.2 would be heading up to around $3 billion Australian. Now, there's no way anybody can tell me that that's like replicating a microcap portfolio.
Yeah.
So I think, if you're starting out in microcaps, I think there's a plethora of good microcap products out there. There's about 6 or 7 LICs. Wilson Asset Management's got one. Acorn has got one. Perennial have got one. Saphira is another one who've got an LIC. And then on the managed fund side, there's at least another 30 ones there from, UBS, Perpetual, Acorn have got one there. Saphira have also got another one. Tony Hansen, who's been on your show, it mightn't say microcap in the name of his fund, but his portfolio would be very much way ahead to the microcap end of the market. OC Funds Management in Melbourne, Novaport Funds Management. There's quite a lot. So, you don't have to go in and start buying microcap shares in order to get exposure. There's some very good fund manager options out there if people want to, I guess, access the asset class from a professionally managed standpoint. And that's another resource probably that I don't use that often, but can also be kind of helpful is, if you sign up to a couple of the managers to their newsletters, you get their little monthly report, or look at the LIC's NTA announcements when they come out every month. They'll usually give the top 5 or top 10 names in the portfolio. And then, that's a way to find new names. Actually, good little trick now that we talk about LICs is, so LICs under ASX listing rules are required to disclose their full portfolio as at June 30 in the annual report. Now, a lot of fund managers want their competition knowing that, so it's usually buried right in the back of the annual report. But I always look at those, because that'll give you every single holding, not just their top 10, every single holding that they had at June 30. And that can be, a great way to find new names, because they might be talking about it in their marketing or their results that they publish on a monthly basis, but they might be slowly building a position. They might be selling out on the flip side. You got to bear that in mind. But in terms of, if you want a list of, probably most of them hold between 30 and 60 names. So you can get those 6 or 7 LICs, get their annual reports, look at the 30 to 60 names that they have in there. And, that can be a great way to start. Okay, here's a mini universe I can go and look at. And the reason I like that for retail investors as well is, you've had institutional fund managers who do this on a day-to-day basis as their job. They've also kind of done a lot of quality control, weeding out of the more promotional spruikers that we talked about. If they've committed their investors' capital into something, I don't think they would have done that without a fair bit of due diligence and research before they've made that commitment. Because as I say, if they've got 1,600 names to choose from, and they end up in a portfolio of 60. They've filtered a lot out to just get down to the 60.
That's one thing that I utilize a lot. I try and get as many good fund managers, analysts, and investors on this program, but it's definitely something that I keep going back to is follow the monthly reports, follow the quarterlies, any commentary, follow them on Twitter, LinkedIn, wherever, because there's some real nuggets that come out of those reports. And it's interesting about the LICs. I didn't even know that. I didn't know that you could get the full report in the annual. I have read some annuals, but I didn't go that far. So they're doing a pretty good job of hiding it.
Yeah, no, it's the same. That's the one other tip I'd give retail investors if they're looking at IPOs. Whenever we were assessing IPOs, Jeff Wilson used to say, start at the back. All the stuff they don't want you to read is at the back.
Great.
Yeah, and that's where you can find a lot of stuff of success fees if the IPO gets away. The CEO is going to get a $500,000 bonus just for getting the thing listed. All these little things that are lumped into IPO costs when you see them on the P&L the first time they report, but it's actually you can find a lot of hairs on things if you start with the IPO prospectus and work from the back to the front. That's
great. It's great. You mentioned you might be putting some pen to paper or some digital paper in the next week or so. it'd be great if you can share that with us, because I'll chuck it in the show notes and hopefully distribute to everyone. One thing I wanted to touch on before I let you go, and I've got a feeling we'll do this again sometime in the future, but the thing that you're working on now, Coffee Microcaps, you said that there have been 2 events. Unfortunately, I didn't get to either of them, but I know a number of investors who went along and said it was the best investing conference they've been to, so credit to you. But maybe you can just give some lip service to the new virtual version of that now.
Yeah, so the new virtual version is we are doing a Coffee Microcaps morning meeting. So instead of having trying to replicate the full day-long conference that we would normally do in person, I'm getting 2 companies in every Thursday morning. Initially, it's going to be on a fortnightly basis. So the next one is happening tomorrow, Thursday, the 23rd of April. The one after that is going to be Thursday, the 7th of May. And the 21st of May. So we have 2 companies. They would do their presentation as they would normally do at the conference. So it's kind of 20 minutes, 15 to 20 slides. And then we leave 10 minutes open for Q&A. Company A presents, and then kind of Company B presents. It's a true webinar format, so it's be on Zoom webinar. I'm sure lots of investors are dialing into conference calls, and I think potentially it's going to be, if things haven't changed a lot by the time we get to November, there'll be a lot of AGMs will be done in the same format. And that way, we can still give a platform, which is what I say how to do, still give a platform for ASX microcap companies to get their story out there, and for ASX microcaps to hear it and engage with the management team in a virtual format for now. But if we were at the in-person conference, it's trying to replicate that as closely as possible. And if people can't join the webinar, if you're one of these new working from home people, the recorded version of the webinar goes up on our new YouTube channel. So all of these Coffee Microcaps morning meetings will start to go up in a playlist there every 2 weeks or so. So if you subscribe, hit the little bell notification icon, you'll get an update when these go live. And that's going to be for the balance of this year, probably where we're going to be doing most of our company-based content. The plan is at this stage to do another in-person conference like the 2 we did in 2019, the last week of October, subject to COVID-19 restrictions having been lifted enough that people can come and travel. Because for the first 2 conferences, I actually had a couple of CEOs. Some came internationally. We had one CEO come from London for the presentation. We had 2 CEOs come over from Perth. I know interstate travel now is extremely restricted, and we have a lot of attendees who come interstate. That last conference I had, one guy flew from Perth. These are retail investors. These are not institutional investors, retail investors. One came from Perth. We had 3 from Adelaide, 3 from Brisbane, 4 from Melbourne, and they're flying up on their own dime to come and see the kind of list of companies that I've managed to pull together for the conference, and hopefully they can walk away with some value from the day.
Yeah, you often find that when you go to these events, that you often don't get the companies that you want to see. You get the ones that can, I don't know, afford to be there, let's say. But I found the companies that you had present, particularly the first time around when I was looking at the list, I was very impressed with what you pulled together. I've got a feeling, Mark, that some of the people that have already tuned into your webinars are going to be a bit disappointed that you've done this promo, because there could be a lot more people watching the next time around. But I mean, that's great for you, and it's great for small caps as well. So I'll just say thanks again, mate, for taking the time out. I'll put some show notes in. I'll put some links to your Twitter, because my understanding is that you're pretty open with Twitter and you love to chat to people. So I'll chuck all that in. And mate, I just want to say thanks again for taking the time out to chat with us.
Thanks for having me on. And yeah, I mean, if anybody wants any companies to be involved in the Coffee Microcaps, morning meeting, please get in touch with me on either on Twitter, or they can email me at mark@coffeemicrocaps.com. I'm very happy to reach out to whatever companies people are interested in, and try and get them on and try and get their story out there.
Yeah, great, mate. It's a great thing you're doing. Once again, Mark, thanks for joining me, mate.
Cheers. Thanks, Owen.